Welcome to Infotech Stocks, your go-to channel for the latest updates in tech and stock markets. This video is AI generated and purely for informational purposes, but we've done the best research to bring you the most accurate insights. If you enjoy cutting-edge news like this, make sure to hit that like button and subscribe for more updates. Nvidia, the darling of the tech world, has been on an absolute tear. Over the past few years, the company has seen unprecedented growth, capturing the attention of investors and tech enthusiasts alike. Their innovative technologies and strategic market moves have positioned them as a leader in the industry. Their stock price has soared to dizzying heights, reflecting the market's confidence in their future prospects. The growth has been nothing short of phenomenal, with the stock price multiplying several times over. Investors are clamoring to get a piece of the action. The excitement is palpable, with many seeing Nvidia as a golden opportunity to capitalize on the booming tech sector. But could this dream run be coming to an end? The stock market is notoriously volatile, and what goes up must come down. Some analysts are beginning to question whether Nvidia can sustain this level of growth. Could Nvidia's stock really plummet to $65? It's a scenario that seems almost unthinkable given their current success. But it's a possibility that cannot be ignored. Let's be clear, folks. Nvidia's success is deeply intertwined with the artificial intelligence boom. Their cutting-edge chips are at the heart of this technological revolution, driving advancements in various fields. They make the chips that power everything from self-driving cars to ChatGPT. These applications are not just futuristic concepts, they are becoming integral parts of our daily lives, and Nvidia is at the forefront of this transformation. The demand for AI is undeniable, but is it sustainable? That's the million-dollar question. As more companies enter the AI space, competition will intensify, and Nvidia will need to continue innovating to maintain its edge. We've seen this story before with tech darlings. Remember the dot-com bubble? Companies that seemed invincible were suddenly vulnerable, and the market corrected itself in a dramatic fashion. Companies soared to unimaginable heights, only to crash back down to earth. The parallels to today's tech market are striking, and it's a reminder that no company is immune to market forces. I'm not saying history will repeat itself, but we need to be cautious. It's essential to look at the fundamentals and not just the hype. Nvidia has strong fundamentals, but the market's expectations are sky high. Don't get caught up in the hype. While Nvidia's future looks promising, it's crucial to stay grounded and make informed decisions. The tech world is full of surprises, and only time will tell if Nvidia can continue its remarkable journey. AI is the hottest thing since sliced bread, or at least that's what everyone keeps telling us. Companies are pouring billions into AI research and development. Governments are scrambling to create AI strategies. It's all anyone can talk about. But here's the thing about hype cycles. They inevitably cool down. Remember when everyone thought virtual reality was going to change the world? Or when 3D printing was going to revolutionize manufacturing? Sometimes these technologies live up to the hype. Other times they fall short. The truth is, we're still in the early innings of the AI revolution. It's too soon to say how big this market will become, and how long the growth will last. We need to be realistic about the potential for a slowdown in AI adoption. Nvidia hasn't cornered the market on AI chips, not by a long shot. Competitors like AMD and Intel are hot on their heels. They're investing heavily in research and development. They're hungry for a piece of the pie. AMD, with its EPIC CPUs and Instinct GPUs, is making serious inroads in the data center market. Intel, the sleeping giant, is finally waking up to the AI opportunity. They're betting big on their Habana Labs acquisition. Competition is heating up, and that means one thing: pressure on Nvidia's market share and pricing power. Nvidia can't afford to rest on its laurels. They need to keep innovating and bringing new products to market, otherwise they risk being left behind. Remember the great chip shortage of 2021 and 2022? The global economy ground to a halt because we couldn't get enough semiconductors. Demand for everything from cars to smartphones to gaming consoles far outstripped supply. The chip shortage has eased somewhat, but the supply chain is still fragile. Any disruption, whether it's a natural disaster, a geopolitical crisis, or even a pandemic, could throw the market into chaos again. Nvidia is not immune to these forces. If they can't get enough chips to meet demand, their sales will suffer. And if the price of chips goes up, their margins will take a hit. It's a delicate balancing act. Margin pressure. A squeeze on profits. In today's competitive business environment, maintaining healthy profit margins is more challenging than ever. Companies are constantly looking for ways to optimize their operations and cut costs. But external factors often make this difficult. Let's talk about margins, folks. Margins are a critical indicator of a company's financial health. They show how efficiently a company can produce and sell its products or services. When margins are high, it means the company is doing well, but when they start to shrink, it can signal trouble ahead. Margins are the lifeblood of any business. They represent the difference between what it costs to make something and what you can sell it for. This difference is crucial because it determines how much profit a company can make. Without healthy margins, even a company with strong sales can struggle to stay afloat. They represent the difference between what it costs to make something and what you can sell it for. For example, if it costs $10 to produce a product and you can sell it for $15, your margin is $5. This $5 is what covers your overhead costs and contributes to your profit. Higher margins mean more profit, which makes investors happy. Investors are always looking for companies that can generate strong returns, and healthy margins are a key part of that equation. When a company can consistently maintain high margins, it signals to investors that the company is well managed and has a competitive edge. Nvidia has enjoyed fat margins in recent years, thanks in part to the high demand for their AI chips. These chips are used in a wide range of applications, from data centers to autonomous vehicles, and the demand for them has been growing rapidly. This has allowed Nvidia to charge premium prices and maintain strong margins, but those margins are under pressure. Why? Competition, for one. As more companies enter the AI chip market, Nvidia is facing increased competition. This competition is forcing Nvidia to lower its prices to stay competitive, which in turn is putting pressure on its margins. As AMD and Intel ramp up their AI offerings, Nvidia will be forced to lower prices to stay competitive. Both AMD and Intel have been investing heavily in their AI chip capabilities, and they are starting to catch up to Nvidia. This increased competition is making it harder for Nvidia to maintain its premium pricing. Then there's the rising cost of manufacturing. The cost of producing AI chips is increasing, driven by factors such as higher raw material prices and increased labor costs. These rising costs are eating into Nvidia's margins, making it more difficult for the company to maintain its profitability. Everything from raw materials to labor is getting more expensive. The prices of key raw materials used in AI chip production, such as silicon, have been rising. At the same time, labor costs are increasing as companies compete for skilled workers. These rising costs are putting additional pressure on Nvidia's margins. And let's not forget about inflation, which is eating away at everyone's bottom line. Inflation is driving up the cost of everything, from raw materials to labor to transportation. This is making it more expensive for Nvidia to produce its AI chips, further squeezing its margins. These factors are putting a squeeze on Nvidia's margins, which could impact their profitability and ultimately, their stock price. If Nvidia is unable to maintain its margins, it could see its profits decline, which would likely lead to a drop in its stock price. This is a key risk that investors need to be aware of. Investor sentiment, the fickle force driving markets. The stock market is a funny thing. It's not always rational. In fact, it can be downright emotional. Investor sentiment, that collective mood of the market, can swing wildly from euphoria to despair. Right now, sentiment around Nvidia is generally positive. Investors are excited about the company's growth prospects in the AI market. But sentiment can change quickly, especially in the tech sector, which is known for its volatility. Any number of things could trigger a shift in sentiment, from a disappointing earnings report to a broader market correction. If investors start to get nervous about Nvidia's future, they may decide to sell their shares, which could send the stock price tumbling. Nvidia's future recovery or correction. This is a question that has been on the minds of many investors and analysts alike. With the stock market's inherent volatility, it's crucial to understand the factors that could influence Nvidia's stock price in the near future. So could Nvidia's stock really crash to $65? It's certainly possible. The stock market is unpredictable and various factors could contribute to such a decline. Investors need to be aware of these potential risks. The risks are real. Cooling AI demand, rising competition, supply chain disruptions, margin pressure, and fickle investor sentiment. Each of these elements can have a significant impact on Nvidia's stock price. For instance, if AI demand slows down, Nvidia's revenue could take a hit. Similarly, increased competition from companies like AMD and Intel could erode Nvidia's market share. Any one of these factors could send the stock price lower. It's a delicate balance, and even a small shift in one area can have a ripple effect throughout the company and its stock performance. But let's not forget about Nvidia's strengths. Despite the risks, Nvidia has several strong points that could help it navigate through these challenges. They are a leader in AI technology. Nvidia's advancements in AI have positioned them at the forefront of this rapidly growing industry. Their GPUs are widely recognized for their performance and efficiency in AI applications. They have a strong brand and a loyal customer base. This brand loyalty can provide a cushion during tough times, as customers continue to choose Nvidia products over competitors, and they have a proven track record of innovation. Nvidia's history of developing cutting-edge technology has consistently kept them ahead of the curve. Their commitment to innovation ensures that they remain relevant and competitive. These factors suggest that Nvidia is well-positioned to weather the storm and emerge stronger in the long run. Their leadership in AI, strong brand, and innovative spirit are significant advantages. The truth is, no one knows for sure what the future holds for Nvidia or any other stock. The market is unpredictable. However, by staying informed and understanding the various factors at play, investors can better navigate this uncertainty. But by understanding the risks and opportunities, investors can make more informed decisions. It's about balancing the potential downsides with the upsides and making strategic choices based on a comprehensive analysis of the situation. What's next for Nvidia? Join the conversation. What do you think, folks? Is Nvidia a buy, a sell, or a hold? Share your thoughts and predictions in the comments below.